Good afternoon, guys. Welcome to today's afternoon briefing, debrief rather. It's going to be a little bit different to normal. We will talk a bit about what's happened today, but essentially what's happened today has been by and large based on one theme and one theme alone, both today and yesterday, and that's what's been going on in China for the last couple of days, the 2 consecutive days of devaluation. So that's pretty much what we're going to focus on today, because that has really been the only real driver of the markets, and it doesn't really matter what markets you trade, whether bonds, equities, currencies, commodities, whether in the developed markets, G3, G10, or the emerging markets. It's had huge ramifications, and I think what I'll do today is not only talk about what's happened, but also what we should be looking out for, and also to go through and look at some of the correlations between markets. I mean, you guys know me long enough by now to know that I look very much at correlations between markets, and looking at one market can provide keys and indicators as to what we can do and what we can profit out of when we trade other markets as well. Okay, so I'm sure you're all aware of what's happened with China the last couple of days, but I'll just go through it briefly anyway. So we saw 2 consecutive days of devaluation of the yuan currency by the Chinese central bank, and over these 2 days we've seen the biggest 2-day decline in the Chinese yuan since 1994, when China ended their dual currency system. Now, just a quick note: the currency is sometimes referred to as the yuan, sometimes as the renminbi. Does anyone know why that is? I didn't actually know till today. Anyone aware? Well, go on, Stick.
Now you tell it.
Okay, it's not that interesting, but useful to know. It's much like the pound and the sterling; they're the same thing, but when you buy something, you buy in yuans, not in renminbis, like you would you'd buy something that's £3, it's not 3 sterlings. So it's basically that, and the historical concept is to do with the renminbi coming about post-communism in China, but I won't go into that. You can read up about that yourself. So those terms can be used interchangeably, not necessarily by me, but when you read stuff and when you hear about stuff from the Squawk, etc., the 2 terms are used interchangeably. So the first devaluation was on Tuesday, when the central bank devalued at the time to its lowest rate against the dollar in almost 3 years, and at the time, and actually not even at the time, but is the single largest drop in the renminbi fixing. And when it happened yesterday, it really did send ripples through global markets. Like I said, no matter what the market was, it had an impact. And on Tuesday, in the statement accompanying Tuesday's fixing announcement, the People's Bank of China said its move was a one-off devaluation. So the renminbi was devalued by 1.9%. They said it's a one-off devaluation, and what they said, and they revealed it basically as a new mechanism to allow market forces to play a greater role in setting the exchange rate in the future. So typically, I wouldn't say they're pegged against the dollar, but there's a fixing in a kind of band against the dollar, and that's what the Chinese central bank said, that it was a one-off devaluation. But then this one-off devaluation was followed last night, Wednesday, by another devaluation, which really got the markets going and sort of brought a bit of panic into the markets, because there seems something a little bit deeper than this so-called one-off devaluation that actually happened 2 days in a row. So today, on the announcement, the currency fell by another 1.6%, which was the second biggest one-day cut since they abandoned their hard peg against the dollar in 2005. So essentially the 2 biggest one-day cut or devaluation of the Chinese exchange rate for quite some time. So now, when we talk about the Chinese currency, there is an onshore market and an offshore market. Now, if I bring this chart up here, essentially the purple line is, this is an hourly chart, the purple line is the offshore market and the orange line is the onshore market. Now, how this actually works is the onshore market is traded only domestically. There's essentially a fixing that the Chinese central bank placed against the dollar. So that's what they've actually been moving around. That's what they've been devaluing, so to speak. But then there is also an offshore market that can be openly traded, and that's the one that we've seen the real volatility in, because the onshore market, it can't really move much more than the actual fixing that the Chinese central bank set. But the offshore market, as indicated by this purple line, has very much overshot, which essentially means that the market's reaction is for further devaluation. Now, normally a devaluation will be looked at, seen as a currency going down, and that would be the case, but remember, we need to remember how the currency is quoted. It's quoted as dollar yuan or dollar China, or however you want to say it. So the dollar is the front leg of that currency pair, so hence a weakening Chinese currency would actually show as an increase in dollar yuan. So looking at it, you can see a very large spike up. This is a daily chart, not an hourly chart, over the last 2 days. The currency is back at levels not seen for the last 5 years or so. In terms of the magnitude of the moves, well, you can see it yourself. There's just this straight line higher, and if we let's see, how do we do this? Not that. Okay, hold on. And if we just look at it over the last year, you can see up from about March onwards, for the last 6 months at least, it's been very stable. Quite a tight, I'm not saying peg, but quite a very tight range, but even for the last year or so. So this is very significant amidst what's been going on. So now we've seen essentially ramifications in other markets, no matter what market you're looking at. We've really seen a lot of, I guess, risk-off type flows on the back of the Chinese devaluation, and we'll talk about potentially why they've devalued and what the implications are. But for other markets, what have we seen? We've seen a typical risk-off move. So if we look at US 10-year bonds, this is an hourly chart. On the announcement itself yesterday, this is a yield chart, so we saw initially in an hourly chart we saw, I guess, a 3 basis point down move in yields, but that continued post the announcement, and we saw essentially yesterday, pretty much for the whole day, yields go from 10-year yields in the US from 223 down to 213 essentially, so 10 basis points lower in US 10-year yields. Bounced a little bit yesterday afternoon, but then the second devaluation from China, and then we went from 215 to 207. So essentially 17 to 18 basis point from high to low down move in yields in the US 10 years, and that's, I've chosen the US 10-year bond, but we can look at the other tenors of the US curve or other bonds in developed markets, and we've seen a similar type thing. Okay, we saw a bit of a pullback. Typically markets will overshoot. It could just be a positioning thing as well. Saw a bit of a pullback, but still we're still, to be honest, where we are now, still 15, but the best part of 15 basis points lower than where we were pre the China announcement. Okay, so if we just look at equities, similar story in terms of the typical risk-off type move. This is the S&P, an hourly chart. Again, this is when it happened 2 days ago. Down move in the equities. And we did get the follow through over the course of the day as well. Didn't move quickly. It just ground a little bit, but then later on yesterday we dropped lower. And then the second devaluation here, we saw a much more aggressive down move, and the trend has just continued. Unlike with the bonds, we haven't really had a bounce today at all. So an hourly chart, we had a slight bounce yesterday, similar to the bond yields, but in terms of the actual equity markets, they've stayed weak and have been very weak today. There's been a massive continuation. Again, it doesn't matter what bond equity markets you've been looking at, whether it's been the S&P, the Eurostock, the FTSE, the DAX, the CAC, whatever it is, they've all been very, very weak. Okay, so if you could just turn the light on, please. So there's been a few thoughts and reasons to why these devaluations have taken place. Any of you got any thoughts on that? Can you tell me why, or what you've read or heard?
Yes.
Yep, Stig.
Something about exporting deflation or some debt or something like that. I didn't really catch on to how the mechanism worked, but something about that.
Okay, indirectly, I suppose. Anyone else?
China prepare itself for a possible hike of the Fed.
Okay, so that's one very very clear reason that perhaps analysts have been talking about, and actually I think it's very plausible. So as we showed from this chart here, the FX chart, the currency against the dollar, been very stable, right? They fix the currency against the dollar every single day. Now, with what's happened to the dollar in the last year or so? It's been very strong. So if they've been fixing it against the dollar, what does that mean for the Chinese currency against every other currency? It becomes strong, right? So they know that the Fed is planning on hiking rates sometime soon. What typically happens to your currency and when interest rate goes up? It strengthens. Yeah. So Fed embark on their hiking cycle whenever it is. Obviously, we've seen a lot of priced into the currency market, but the dollar has strengthened, and because the currency, the FX between China and the dollar is so stable, essentially that has caused the Chinese currency to also strengthen. So if you look at a chart of China against every other currency, the yuan is actually very, very strong. So in order to kind of not have to sell dollars as part of their FX management, they've essentially just changed this, they've just essentially devalued against the dollar. Similarly, it can be viewed a little bit similarly to what happened with Switzerland and the Swiss currency when the ECB were pre-QE. Now that was a different story because Euro Swiss, there was a floor in Euro Swiss, and essentially the Swiss franc, the euro, was weakening because of the impending QE from the ECB. So hence the Swissy was weakening because they had a peg against the euro. Now, in order for them, so basically the Swiss currency was weakening against every other currency because the euro was, not because it was fundamentally weak, and that's why the Swiss dropped their peg. So it could be, there are a lot of parallels between why this could be happening, because they just can't maintain that peg with the dollar. That's one reason potentially. Anyone else know another reason why they could be doing the devaluation?
The economy slowing down.
Exactly, the economy slowing down. And I think that's more what the market are focused on. Their economy slowing down, so they're devaluing their currency to make their terms of trade more competitive, and what have you. Now, it could be the economy slowing down, or it could be that Chinese data is often inaccurate. It could actually be the case is that Chinese data has been a little on the soft side, but maybe actually it's not just slowing down, the data is actually worse than actually what's being published. So that's some sort of, that could be a conspiracy theory, but that could be another reason. So essentially, a hard landing for China could come about if they don't devalue. And there's one other reason as well, which China actually mentioned themselves. The central bank actually mentioned themselves.
To become a reserve?
Yeah.
Currency?
So, People's Bank of China, they essentially desire to attain reserve currency status at the IMF, and in order to do that, they have to have kind of a fully floating exchange rate in essence. So they need to gradually let the currency float, and if they believe it's overvalued, they needed to devalue. So again, it's been roughly flat against the dollar for much of the year, risen sharply against other currencies, notably the euro and the yen. And essentially they needed it to revalue to have something more, I guess, more fair value against those currencies, against, say, the euro, the yen, and just sticking it at this artificial peg against the dollar is not really doing the job for them. Okay, so we've seen. Okay, so we've seen the bond yields go down, so bond markets rally on the back of this. We've seen equities sell off on the back of this. So now we know on any China news what these two markets will do. We've seen it one day, we saw it the second day. The second day the moves were more pronounced. Why do you think they may have been more pronounced the second day?
Because they told us that they wanted to do it.
One is they said they weren't going to do it, but two, because actually, if China doing it once, that's fine, but there must be, for them to do it 2 days in a row, maybe there's an underlying problem here. And China, I know I've talked a lot to the grads about it, the new grads about it during the course. What did I say to look at once Greece is out the way? Oil, China, and it's very much coming into focus now. While Greece was in focus, no one was really paying attention to Chinese data. No one was really paying that much attention to China, but this is a huge deal because China has been the engine of global growth ever since the financial crisis. Everyone's been growing at negatively or less than 1-2%. China's been growing. We started off 12%, now it's still 6-7% plus. So it's been really the engine of global growth, and for China to be slowing down or coming into a little bit of trouble is a huge deal, because if China aren't growing, if Chinese economy aren't doing well, who is going to support growth globally? Okay, so bond markets, yes, we've seen kind of what we'd expect on a global slowdown type environment. Equities the same. Now, if we look at the US dollar, what actually happened there? What do you think happened? What will you tell me what happened? What's happened to the US dollar? It went up. Did it stay up? Okay. Anyone else?
The dollar index compared to the
Just
euro?
the dollar index compared to the euro, whatever.
So euro dollar increase.
Euro dollar. So the dollar's gone down. Does that mean?
Yeah, the dollar's going down.
Okay. So that's what's actually happened, and now it's a little bit strange how it's happened. If we go here, it's an hourly chart again. Yesterday, the devaluation, the dollar went up, as you'd probably expect, right? Because this is the dollar index. You can switch the light off, please. As you'd expect, essentially, if the Chinese currency is devalued, the dollar is strengthening relative to it. So the knee-jerk reaction was for the dollar. This is the dollar index to go up. But what actually happened here? Actually, and the knee-jerk reaction here to today, when it happened, dollar went up. Now, what we actually saw both days was quite interesting. London open, back down. London open, back down. Got sold heavily. The dollar got sold heavily from the London open. It's quite telling. Why? Anyone have an idea why that might have been the case?
Interest rate hikes?
Potentially. There's been talk now that the Fed might delay their interest rate hikes because of weakness in China. How plausible that is, who knows? But that's what the sentiment very much has been, because really a devaluation in China should cause the dollar to go up. And initially the knee-jerk reactions was for it to go up. But from the, like I showed, from the London Open, pretty much they've been sold. So essentially it's kind of telling us that the market is thinking the Fed might take note of what's going on in China, potentially the weakness in China, the weak economy, the need for them to devalue, the changing terms of trade, that might encourage the Fed to delay the first rate hike. Now, whether that happens or not is another matter, but it seems very much like that's what the market is thinking. And if you look at the short end of the US curve, you'll see the stairs have also rallied in the last couple of days as well. Okay. Another area where we've seen the Chinese devaluation really impact is emerging market currencies. Does anyone know what's happened there? Sorry?
They followed?
Yes, they have followed. Now, pretty much all Asian currencies got hammered. Obviously, the Chinese were off the most, but whether you look at Indonesia, whether you look at South Korea, whether you look at Singapore, it doesn't matter. They all got absolutely hammered the last 2 days. And the one I'll bring up here is the Korean won. Now again, it's quoted as dollar Korea, so a weakening of Korea is actually a move up. So on the devaluation, initial knee-jerk reaction is to go up, so the Korean currency to weaken, and again today did the same. Now, yesterday we had a continuation of the weakness, and this applies to all emerging markets, whichever one you want to look at. Today we got a reversal. The reversal was more dollar-led, as we saw today. When we showed the dollar chart, we've had real dollar weakness today, the whole day. And so basically, the reversal here in the emerging markets currencies has been dollar-led, and that's why we've seen, what is that? That's the S&P, sorry. And that's why we've seen the emerging markets bounce back, essentially. But there is the potential for the emerging markets, once the dollar calms down a bit, to keep going, because what we've seen in the past is when one country devalues, other countries follow suit. Why would that be? Well, their terms of trade have just shifted massively. If China's a big trading partner, their essentially terms of trade have changed. Their international competitiveness relative to China has changed. So what you sometimes see is one country devalues, then they all follow suit, and then you get currency wars. Then this is essentially similar to, not similar, but what happened during the 1997 Asian crisis, when it was a Thai baht that got obliterated. Then every Asian country followed suit because they needed to devalue their own currencies. So it's just something to be aware of, and this is why potentially emerging markets, you could see a continuation in weakness in these emerging market currencies. Not only emerging market currencies, you'll probably see money go out of emerging market bonds, out of emerging market equity, basically in times of stress, panic, risk off, whatever you want to call it. People will take their money out of the emerging markets, whether it's the currency, whether it's the bond markets, whether it's the equity markets, and that is what could cause a full-blown crisis if that happens. Now, we're not anywhere near that stage, but just be aware that this is something that could happen and could escalate further. So don't be surprised. Do your research how these things materialize, because this is how essentially a financial crisis can start. Don't be a lazy trader that just waits and sees what happens. Just do your research. Go back, have a look what happened in 1997. Even have a look at what happened when the Fed start talking about tapering, stopping QE. All the emerging market currencies, everyone took their money out of the emerging market currencies because the perception that yields in the US were going to rise, so they took their money out and put it into US assets again, because the recovery in the US had supposedly started. So just that's something very much to be aware of. And initial knee-jerk, right, we know that, but you could see continuation. This here is very much dollar-led, as we showed by the other chart. Now again, the new grads will definitely know this because I mentioned it many times, but which countries are most sensitive to China? Australia, yes, Australia in particular. So if we look what the Aussie currency done, the Aussie dollar, yesterday, initial devaluation, bang, Aussie got hit straight away. Continued pretty much, had a small bounce, continued. Again today, bang, Aussie dollar got hit straight away. This is, pretty much a whole point both times, straight away. Again, we've seen that, like with the emerging markets, we've seen the reversal today, but that's more on the US dollar weakness as opposed to Aussie dollar strength. So remember that. And this is quite telling. It's very clear it's US dollar weakness because we've seen everything go up against the dollar today. But Australia is one of those things that is very tightly correlated with China, very dependent on China. China is their biggest trade partner. If China's doing badly, Australia will suffer, whether it be in their economy, and that will be reflected in their currency. So a weak China will probably lead to a weak Australia in terms of the currency space. So in terms of stuff that we can trade, Aussie dollar is another thing we can trade. We can trade global bonds, we can trade global equities, we can trade currencies. Now if you're going to trade currencies, the Aussie dollar is probably the one where you get the most bang for your buck. Out of the ones that we can trade, because we can't trade the emerging market currencies. But the Aussie dollar is something that you guys can all trade and all look at very, very, very clearly. So if we look at the Aussie dollar, fell basically 0.6% yesterday, 0.6% today before bouncing back. Okay, if you could just put the light on, please. So has anyone got any questions regarding what we've just covered then? Some of the moves, why they've done it potentially. Anyone? Okay. But why this is important, guys, because this is going to run and run. The China story is not going away. And like I said, I'll reiterate again, we've spoken to the newest grads about this potentially being one of the big stories of this year and into next year, because we've seen in the last couple of weeks weak Chinese stock market. That's had impacts on equities and bonds to an extent. But this, we've seen everything, emerging market currencies, commodities, which I haven't shown here, but copper's absolutely got hammered as well. China is a very big player in the copper market, and copper, especially in Australia, the mining industry in Australia is very copper-led as well. But ongoing, whether it's further devaluation, whether it's further weakness, whatever it is, you know how you can trade based on China. If it's an interest rate cut, you know what to do. If it's weak Chinese data, you know what to do. And remember, things in China don't have to happen in Asian hours. We've seen interest rate cuts in China at midday London time. They're normally very unscheduled. If it's comments around in China, whether it be the IMF, whether it be whoever, you know what to do. You know, if it's bad news for China, buy bonds. Knee-jerk, what do you do? Maybe buy dollars. Maybe in the longer term, no. But knee-jerk, we've seen buy dollars. Sell the Aussie dollar. sell emerging markets, but we can't do that. But that could move first. We might see emerging markets move before everything else. So remember, use these as indicators. Equities, pretty obvious. Sell the equities on bad Chinese news. The market has now told us how it's going to react. So on good news, we know. On good China news, we know how to trade. We know the opposite. So don't feel like you guys, we missed the moves because they were here. They took place overnight, essentially. But just because we missed the overnight moves, there are still opportunities to profit out of these things. And we can continue to profit out of it. So, have the right ladders up, because copper is probably something you should have up over the next few days, because that will be something that moves. Have the Aussie dollar up, even if it's stuff not that you don't normally have up. But at the moment, the only real thing is China driving the markets, and we've seen that today and yesterday, and pretty much everything I'm reading in the FT or on listening out of the Squawk Box is China related. So don't be lazy, and don't be, I trade the Bund, I don't need to look at this. You do need to look at it, because you'll get opportunity on the Bund in the back of it. You'll get opportunity in Euro stocks on the back of it. Those who are trading spreads, it's maybe not as relevant, but don't just ignore it, because there might be an opportunity. You might have a Bund BTP spread that you're able to trade. Risk on versus risk off. Essentially, these markets are trading like risk. It's trading risk off markets, not because of a bit of bad data, but because of the fear of global slowdown. And that's what you all need to remember. And really, I would really encourage all of you to go away and see just do a little bit of research on the 1997 Asian crisis, because it didn't start off with a Chinese devaluation, but the mechanisms and mechanics behind it could be important and informative as to what could happen. It's probably unlikely, but it could happen. I was speaking to John earlier. He thinks that maybe Russia could devalue or something along the lines of that. But if one follows, you could get these currency war games. This happens. Competitiveness changes. If China's the biggest trading partner and they've devalued, everyone else's currency has appreciated relative to China's. So they may need to devalue their currencies. And again, because of risk on, risk off, what normally happens in risk off, everyone takes their money out of risky assets and puts them into safe havens. The US bonds, the German bonds, gold, Swiss franc. And I hope all of you saw the thing I did yesterday on the euro. Again, what's happening, that you could trade the euro and make money, and risk on, risk off. It's important to realize when it is a risk-based move, though. But there are so many opportunities that are coming from it. I mean, I've shown you the Chinese market, the US 10-year, the S&P, the dollar index, the Korean won, the Aussie dollar. I could show you so many more, and you'd see there are trade opportunities there. So don't get left behind. So tomorrow, what are you going to do first thing when you come in? Copper? No, you're going to get the copper ladder up today. What are you going to? Okay, good.
See if it's been another.
Exactly. See if there's been another. Just see what's been happening in China overnight. Sentiment. See what the yen is doing. It's a measure of risk. See what the Korean won is doing. It's a measure of risk. And if all these things line up together, you see bonds go up. You see equities go down. You see an emerging market currency go down. You see copper go down. It could actually provide some information elsewhere. And you see maybe the euro hasn't done anything. What did we say? Euro risk off now. It's considered on risk off, the euro's been going up. Euro hasn't moved. Maybe you can buy the euro. Who knows? Maybe not. But if you're looking at all these things, this is where you spot opportunities, because chances are, in Asian hours, do you think anyone's going to be going to trade euro dollar on the back of a Chinese devaluation? Probably not. I mean, why would you? There are so many other things you can trade in those hours. But as we showed from the dollar chart, the dollar only really moved when London came in. Okay. Any questions, anyone?
Maybe one, what is the long term, because if they're all gonna devaluate, what's the point in doing it?
For China, well, China have done it for their own good. Basically,
Yeah,
they
but
don't
the
really.
rest is gonna fall.
Yeah, that's why it becomes a stupid game, really.
Yeah.
But it's what happened. But China are just trying to devalue against the US essentially. They're not trying to devalue against everyone. They're just devaluing against the US because to maintain what they have been essentially not pegging against but fixing against, they need to always sell US dollars to maintain their currency against the dollar. So if they're selling US dollars, the dollar's going up, they just keep having to sell US dollars just to maintain that peg, and they're like, you know what, I don't want to sell US dollars anymore because the dollar should be higher relative to our currency. But then everyone else, because it's the magnitude, it's when things happen quickly that causes a problem. If it just went gradually, no one would bother. But when you move 3% in a 2-day period, it's a big deal. And that means it's not just against the dollar, it's every other trading partner is impacted. So I'm not saying it will happen, and to be honest, the move in the dollar today, the weakness in the dollar is probably, it's actually a good thing for those emerging markets, because it sort of hides what's going on a little. It hides any kind of threat of imminent mass devaluations. But definitely this could run for a while. It's quiet summer market, so the moves could be a bit more exaggerated. But it's in thin liquidity that sometimes these moves actually really go quickly because the liquidity is not there. People still have business to do. Those who have longer term positions have to get out if they need to get out, and they need to get out in thin markets. So something that might move the market normally 30 ticks could move at 60 ticks or 80 ticks or 100 ticks. So just be aware. But anyway, tonight, obviously tomorrow morning, first thing, see what's happened in China, see what's happened to the Nikkei, S&P overnight in the overnight market, the Aussie dollar. Even if you don't trade these things, guys, it will really aid your understanding. And I can't stress to you how important it is to be aware. Global financial crisis. Not saying this is going to happen. But it started somewhere. And it's the guys who can't adapt and realize what's going on that won't be able to make money, they'll lose money. But you guys, you all want to make money out of this, you all want to profit out of this, so do the research, just be aware. And maybe before today's debrief or my little run through on China, you might not even thought about looking at all these things. But now I've essentially told you currencies, emerging markets, commodities, whatever it is, you've been guided. So just use the advice and information we're providing, and it will help you, whether it's in your trading, whether it's just your understanding, whether there's nothing now to really profit out. Maybe 6 months down the line something else might happen. 6 months down the line, China devalue again, you'll know exactly what to do. And that's where it's important. History repeats itself again and again, whether it be interest rate cycles, whether it be currency devaluations, whether it be bomb scares, terrorist attacks. It happens again and again. This essentially is a carbon copy with markets of what happened during when the Swiss dropped their peg. Equities got hammered. Bonds rallied initially quite quickly. Currencies moved in a fashion you'd expect them to move. But history repeats itself over and over again. Not exactly the same thing, but in a different guise, I guess. Anyway, any questions? Okay, well, that's it. I hope you found it useful, and if there are any opportunities regarding China tomorrow or in the next days and weeks, good luck, and I hope you do well out of it.
Thank you.